studying your last two. I swim med tea when they turned in. The staring down to mute. And can learn the pole that sunk he died.
In this slide, we'll introduce Schedule 3, one of the most important schedules in the T2 corporate tax return for reporting dividends. Schedule 3 is used to report dividends received from Canadian corporations, as well as taxable dividends paid by the corporation to its shareholders. Think of it as the corporation's dividend tracking schedule. Let's begin with dividends received. When a corporation owns shares in another Canadian corporation, it may receive dividend payments on those shares. These Canadian dividends are reported on Schedule 3. One major benefit of Canadian corporate dividends is the Section 112 deduction. In many situations, this deduction allows the receiving corporation to deduct the dividend from its taxable income. This helps prevent the same corporate profits from being taxed multiple times as they move from one corporation to another. However, receiving Canadian dividends may also result in Part 4 tax. This is a special refundable tax that we'll discuss in the next slide. Now it's important to distinguish Canadian dividends from foreign dividends. Foreign dividends, such as dividends received from companies outside Canada, are generally not reported on Schedule 3. Instead, they are treated as investment income and are typically reported through Schedule 7, where they become part of the corporation's investment income calculations. The comparison table summarizes the key differences. Canadian dividends are reported on Schedule 3, may qualify for the Section 112 deduction, and may trigger Part 4 tax. Foreign dividends follow different tax rules and are generally reported as foreign investment income through Schedule 7. The most important point to remember is this: Schedule 3 is designed specifically for Canadian corporate dividends. Whenever a corporation receives dividends from another Canadian corporation or pays taxable dividends to its own shareholders, Schedule 3 is the primary schedule used to report those transactions. Now let's look at one of the most unique features of Schedule 3, its calculation of Part 4 tax. Suppose a corporation receives $14,000 of dividends from another Canadian corporation. At first glance, you might think these dividends would simply be added to the corporation's taxable income. However, that's not how the Canadian corporate tax system works. To prevent the same corporate profits from being taxed multiple times, the Income Tax Act provides the Section 112 deduction. In many situations, this deduction allows the receiving corporation to deduct the full amount of eligible Canadian dividends from its taxable income. In other words, the dividend is generally not taxed again as regular corporate income. But that's only part of the story. Schedule 3 must also determine whether Part 4 tax applies. Part 4 tax is a special refundable tax that is imposed on certain Canadian dividends received by private corporations. The current rate is approximately 38 1/3% of the applicable dividends. Using our example, if the corporation receives $14,000 of Canadian dividends, the Part 4 tax would be approximately $5,367. At first, this may seem like an extra tax burden. However, it's important to understand that Part 4 tax is temporary, not permanent. The corporation pays this amount to the Canada Revenue Agency, where it is held as a refundable tax balance. Later, when the corporation pays taxable dividends to its own shareholders, all or part of this Part 4 tax may be refunded to the corporation. This mechanism ensures that corporate investment income is ultimately taxed when profits are distributed to shareholders, while avoiding permanent double taxation within the corporate system. The key takeaway is simple. Section 112 prevents Canadian dividends from being taxed twice, while Part 4 tax temporarily holds back part of the tax until the corporation distributes dividends to its shareholders. Think of Part 4 tax as a refundable deposit rather than a permanent tax expense. In this final slide, let's complete the dividend story by understanding what happens after a corporation receives dividends. As we learned earlier, Canadian dividends received by a corporation are reported on Schedule 3. Depending on the circumstances, those dividends may also result in Part 4 tax. But the process doesn't end there. When the corporation later pays taxable dividends to its own shareholders, something important happens. The corporation may become eligible for a dividend refund. This refund allows the corporation to recover all or part of the Part 4 tax that it previously paid. Think of it as a complete cycle. First, the corporation receives Canadian dividends. Next, those dividends are reported on Schedule 3. If applicable, Part 4 tax is calculated and paid. Later, when the corporation distributes dividends to its shareholders, the Canada Revenue Agency may refund that Part 4 tax. This is why Part 4 tax is considered temporary rather than permanent. Schedule 3 also connects with several other schedules in the T2 corporate tax return. While Schedule 3 focuses on Canadian dividends received and taxable dividends paid, Schedule 7 deals with other types of investment income, such as interest income, rental income, capital gains, and foreign dividends. Together, these schedules ensure that all types of investment income are reported correctly. Schedule 3 also connects with Schedule 53, which tracks the corporation's general rate income pool, or GRIP. GRIP helps determine whether dividends paid to shareholders can be designated as eligible dividends. The slide also introduces the difference between eligible dividends and non-eligible dividends. Eligible dividends are generally paid from income that has already been taxed at the higher general corporate tax rate and are supported by the corporation's GRIP balance. Non-eligible dividends are generally paid from income taxed at the lower small business rate and do not require GRIP. Finally, the checklist summarizes the key responsibilities of Schedule 3. It reports Canadian dividends received, reports taxable dividends paid to shareholders, calculates Part 4 tax, supports dividend refund calculations, and connects with both Schedule 7 and Schedule 53 to ensure the corporation's dividend reporting is complete. The most important concept to remember is this. Schedule 3 follows the entire dividend lifecycle from receiving dividends, to calculating temporary Part 4 tax, to paying dividends, and finally to receiving the dividend refund. It is the central schedule for tracking corporate dividend transactions within the T2 tax return.